Hello, everybody. It's Clayton again, coming back with a new episode. As you can see, the portfolio has gone up a little bit. I'll explain why. I had my semi-monthly deposit go in. I also wanted to address a viewer question that I have been asked offline by a few people that I really feel is important about what you should do if you have a smaller starting base when it comes to what you can invest. But before I dive in any of that, obviously we've seen the market yesterday, which was the second, shot up. It was an all-time high for the most points ever gained in a single day in the history of the stock market. And then today it's kind of fallen back down. I think it went down like 700, 800 points today. Today's the 3rd of March. I'm not really going to just talk about why it fell anymore, the pandemic, or has everyone, we all know what I'm talking about. The reason I'm not using the words for it is YouTube is not a fan of that currently, and they've addressed that they're kind of stopping videos from getting pushed out there. So just wanted to kind of get that off my chest and say, obviously, for anyone that's been affected, I hope you and your family are safe. And if something happens to a loved one, I am truly sorry. But I want to put the focus on a positive note while this is going on. So as you see, the portfolio is now up to 1647. That's just because I deposited money, excuse me. And I want to show you actually what I deposited. There was the 125, and I got 54 cents from the dividends reinvested themselves. But I picked up 2 stocks that I haven't even addressed yet, and you'll see in my portfolio that obviously Disney got me some, AT&T, but these 2 right here, JP Morgan and Target. And I haven't even talked about these in other videos. Before I was talking about Ford. I may have talked about Chase, actually, thinking back of it in a previous video, but I know I didn't talk about Target. And I want to address these specifically myself. So Target one, my wife loves Target. My family shops at Target all the time. Walmart, Target, and I live here in Florida, so Publix are our 3 kind of grocery stops. We also shop at like Dollar Tree and whatever we can find the lowest prices. We try to save as much money. But she just loves Target, and they've got products for our son that when it comes to diapers and things like that, that we just can't seem to find anywhere else for a better price. So with Target, I know I've said in the past with things like Microsoft and other industries that I have a yield rate that I want to sit around 3%. That's where I'm comfortable. But with Target, you'll see it's at a 2.42 right now. And obviously the market with everything else let me go back to its Dow. You can see it's kind of bounced around. It topped out at what? 130. Now it's at 105. So it's done $25 from the high, which was, when was the high? Back in January? Yeah, back in January. So with this dividend, the reason why I kind of jumped on this, and I feel this is one that I'm going to hold on to for a long time, is you can see with the dividend growth right here, and I'll pull up their dividend history, they have been a dividend that has continuously paid out for now 51 years, and they're always raising their dividend year in and year out. And to me, that is one that I see this being one that with all of my dividends, one that I'm going to hold for the rest of my life until I retire, ideally, unless something really drastic comes up. But Target is one that I know we shop at a lot, and I like to always kind of have a vested interest in somewhere that I'm going to spend my money anyways. Why not get a little bit back from the company? So that was why I went with Target. I think it's a great company for the future. It's shown now for 50 years that for dividend growth, it's a great thing to hold. The yield's a little low, in my opinion. It's still a safe yield by any means. 2.5 is probably 2.2 is probably the lowest I'd go realistically, besides Disney. But 2.4 is not too bad. And the payout ratio, they still got 59% that isn't going towards. So we're good on that. The other one was Chase. And this kind of falls under the exact same category. There's a 2.96. Dividend to me is good. The growth's been going for 9 years. Obviously, we had with the bank crisis that happened when they got bailed out. That was when you'll see the dividend fell. But prior to that, they were going perfectly fine, and their dividend continued to increase. And the main thing with Chase is the same thing. My bank is Chase. Well, my main bank isn't Chase, but Chase is where I keep my checking account. My credit cards are through Chase. So again, if it's something I'm going to have a vested interest in and I'm going to be using, why not invest in them if it's a good dividend payout? And for me, I feel like this is a good dividend payout. The value has dropped significantly for Chase as well. So it's one that I picked up. They topped out at 141. So they're, again, almost down $30, just like Target. So I wanted to show you the 2 things I put in my portfolio. I want to be very honest with you guys. I've said it from the get-go. If I do well, I'm going to show you. If I do poorly, I'm going to show you. Regardless of how the market ebbs and flows, I'm going to continue to show you my portfolio. And I'm not just going to show you when I'm in the green. That's not realistic for anybody that's investing. And I don't want to paint a picture. Like, I just don't want to paint that picture. I want to be honest with you and upfront the whole way through. So with that being said, there is a comment that I got on my last video, which, by the way, before I go any further, I always want to say thank you. I've now hit, I think I'm up to 54 subscribers, which I laugh at when I see that number because, again, it's so minimal to other people, but to me, it's amazing. And my last video hit up to like 300 views, which is by far the most, has by far the most likes. And for anyone that has shared that video, liked that video, or anything along those lines, you do not understand how much it means to me. I truly, truly, truly appreciate it. Thank you. With that said, if you'd like to like this video, subscribe. If you're new to the channel, leave a comment, which is what I'm actually about to address as a user comment, and it's probably going to take up the next 5 to 10 minutes of this video. Please do below. I'd love to hear from any of you, and I truly appreciate the support. I'm going to invest like this either way, but it's always nice to see other people watching, learning, and things like that. So there was a user by the name of Wolf. Enjoy the name, nothing here. And it's a relatively long comment, but I want to kind of dive into it. The comment says, I am much more limited on money now as the rent, I apologize for that, at my house on campus increased. I only have about $150 to start with. Do you think it's still worth it, or should I save up before starting? And if I should do, you think I should buy CCL or 3M? Let's work on reading first. Maybe I should work on that. The rest of the comment states, I am new to Dividend, so I'm really appreciating all of your videos and love all the advice you give, as well as how close up you are with your viewers, telling them everything and not hiding a portfolio, for example. Anyways, any advice is helpful. First off, Wolf, it's just funny to say that name out loud. I appreciate the question. I appreciate the support, and I appreciate the kind words. It really does mean a lot to me, seeing that. Now, I want to kind of break down your question into multiple answers. So the first question I would have, you said that is $150 enough? The answer is $5 is enough. It doesn't matter what you had. You're going to hear different people say you shouldn't invest if you can only invest 10, 15, 20, 35, 30, $40. I disagree with that, and I'll explain why in a second. But the first thing that needs to be addressed before you do any form of investing, and this depends on every single person, you need to make sure that you have an emergency fund set up. I don't know if I've spoken about emergency funds in the past, but an emergency fund, for those who don't know, is about 3 to 6 months worth of your expenses that you live on. In case for some reason you lose your job, something happens, you want to make sure you have money you can access to continue living your life and not have all that money tied up somewhere else where you couldn't get to it. So to answer your first question where you say if it's $150 enough, if you've got enough to cover 3 to 6 months worth of your expenses, then I would say go for it in a heartbeat. It is never, ever, ever too early to invest. Now, if you're putting that $150, but it's leaving where you have little money to cover your expenses if something were to happen, then I would say hold off for now and save up. But you're not saving up to grow a larger bankroll to invest with. That's not what it's for. It's simply meant for saving up for an emergency fund. Now, once you hit that 3 to 6 month, again, that's whatever you're comfortable with. If you have a job and you feel like your income is stable and your job is stable, then you can maybe go 3 months. I myself like to keep around 6 months because you never know what's going to happen in this world, in this economy. But let's just take your example of $150. And I'm going to go a drastic example on this. But let's just say you can only have $150 to invest for the entire year. I'm assuming you mean $150 currently to invest, but I'm going to go drastically $150 for the year. So let's pull up a compound interest calculator. So let's say your current principal, you deposit $150. And then every year you added another $150. And the average YouTube user that watches the financial videos, my analytics aren't large enough yet so I can get my audience. But from what I've seen from other channels, it's usually around 25 to 35. There are plenty that are older and there are plenty that are younger. But just for this example, I'm going to use a 30-year-old. So let's say hypothetically you put this in the market, $150 every year for the next 30 years till you're 60 years old, with an annual return of 4%, which is not at all hard to find, depending on what you invest in. There's plenty of ETFs that you can invest in that you'll get this return. And I can go into way more detail about ETFs. I personally don't do ETFs, not because they're not a safer bet. ETFs are one of the safer bets in my opinion. I just like to have control of the companies I carry and I hold. Personal opinion, some people don't like that idea. They just like to invest in ETF and let it kind of roll along with the market. That's perfectly fine and respectable. But with my example, let's just say for 30 years you get $150 per year you put in the market. That would get you $9,235 by the time you are 60. I know it doesn't sound like a lot, but there's a reason I'm using this minimal of an example. So let's say realistically, you just have 30 years of that. So you've essentially doubled your money if you've got the money invested into your account. You see, what's the difference? 923.5. Yeah, so you've more than doubled your money if you just invest with that $150 yearly. Again, I don't know everyone's personal situations, but please, please, please never feel that you do not have enough to get in the market. You just need to do what you're comfortable with and what is okay for you and your family and what will not hinder you if something were to happen. Because you're still taking risks with the market, and that's important to always remember. So to answer the question, if you've already got an emergency fund saved up and you can put away $150 a year or whatever works for you, yes, I would say definitely do it. I'm no financial advisor, so please do not take what I say as truth or something that you should base a decision off of. You need to obviously do your own research on everything when it comes to how you are comfortably and how your family's going to be, what you want to invest in. I simply show you the stocks that I use. And going back to the emergency fund that I've kind of touched on briefly, I know a lot of people, myself included, because I only switched from this about a year ago because I got on the boat late, I guess. So I had my money sitting in Chase for the longest time in my savings account. It was earning, I think, 0.03% interest annually, which I didn't think anything of because I never really did the research for it. And this is where the mistakes fell on my part. But an example of a bank account that I would recommend that I personally have my money in now for my savings is Ally. Ally pays a 1.6% annual interest, annual yield, for your money. So if you've got a savings account and it's sitting in a Chase or it's sitting in a Wells Fargo or it's sitting in basically any other bank you can, SunTrust, I would feel comfortable telling you to move it to an online savings account with a high yield because you're going to earn a lot more money, obviously, based off of that. And it's just a good way to kind of also get a little bit more income coming in for your savings that you're not touching anyways. It's just sitting in your bank, you're not touching. But that's simply for the emergency fund like I was talking about. That's where we keep our money. Checking just to pay bills. I take out a little bit here or there. So to address the other question that was kind of in there, you said, should you start with buying maybe Carnival Cruise Lines or 3M? Another one that I've seen on groups because it's like $7 now. And I think I talked about last week is Ford. The ones that you need to invest in, do not really worry about the value of the stock. I understand, I'm not saying jump in and buy Apple, which is selling at now, what is it, 200 and may even be at 30. I know it's been getting a hit with the market fall. So what's it at now? 289. So I wouldn't say Apple, but I would say try to find one that's a little bit more, like the dividend yield is a pretty good return for you. So anything 3%, 4% with that amount of money, that is a reliable, safe stock. I personally would say yes to 3M and CL or CCL, Carnival. But you need to do what you feel comfortable with in an industry that you understand. Don't just invest money into something because you want to invest money. Make sure you understand what's going on. You see the ebbs and flows of it. You see its history, what it's doing. Another good company you could invest in is something like Home Depot. Costco is another one that's continuing to grow. You want to just kind of invest in something that ideally down the road, there's a term called a moat. And I know I'm kind of jumping all over the place, but in the investing industry, a moat is one where if you picture like a castle, it's surrounded and it's protected on all sides. And that's an industry you would want to kind of get into, is one that doesn't have a lot of competitors that are trying to take it down or get rid of it. Those are ones, that's why Home Depot and Lowe's to me are really good. Even though I don't have either stock, I'll probably pick them up soon because they're the only ones kind of in that industry. Ace is in it, but Ace hasn't really done a lot of damage to those two corporate giants. And you've seen what Amazon's doing to the retail market. Like Macy's doesn't have that moat anymore. Target has diversified itself. They're starting to do a lot more online shopping. Obviously they carry food and they're kind of like Walmart now. So to me, they're a safe moat, quote unquote. But as for what you should invest in, it needs to be something you're comfortable with. I'm comfortable with the ones I have. I've talked about them all in the past with CCL and AT&T and Wells Fargo and you name it. These are ones I'm comfortable with. Even Coke's a good one in my opinion. But you need to do one that you feel comfortable with and safe with. But do not worry about the dollar amount of the stock much. and do not worry about what you're investing. I would love to see that you invested $20 today and then to do nothing and sit on your hands with it. If it's money that you have no purpose for and it's money that's not being saved up for an emergency fund and you're just keeping it to hold on to it, then disappointment isn't the right word, because that sounds weird to say I'm disappointed in you. But to me, that's when you need to invest. When the money isn't being saved up for an emergency, and the longer you wait to invest, the less growth you're going to see from that investment. And especially with dividend investing, as you know, you said you're new to dividend investing, but I'm assuming you've done research on it. And as I've shown with my portfolio itself, the investments come in relatively quickly. Yes, I'm only getting $10 in dividends after 2 months. That's not a lot. You'll see other channels and other portfolios are getting thousands. I'm not there. The goal is to be there in the future, but right now I'm not there, and I'm not ignorant to the fact of that. But to answer your question, Wolf Wolf, there is no dollar amount that's too low for you to start investing. As long as you've got emergency funds set up and your family is okay and comfortable, I would say invest whatever you feel comfortable with investing. Secondly, just invest in whatever you feel is the best stocks once you've done your research. Something that you feel that you won't stress out when you see the gains fall like they're doing right now for me. Something that won't affect you when you see the industry or the market start to crash. It's not crashing, it's more of a correction, but let's just say it does crash. Something that you won't freak out and overreact when you see that, because you're in a company that you know will correct itself and be back in the green in a few months, years, whatever the time frame may be. You're investing for the long haul. You're not investing for a short profit. If you're investing for a short profit, dividends isn't the way to go, and I may not be the channel to watch for that, but I'm assuming you're not because of the question you asked. So sorry for rambling. I really just wanted to address your question because to me it's very important. And yeah, that's how I'll end it. So again, thank you for everybody for watching. I already said it earlier in the video, but I really, really appreciate the love that I've been getting. I can't even believe I'm at 50 subscribers. I thought I'd be maybe 5 by now, 7, 10, maybe. I really appreciate the feedback, comments, the love, the likes, just everything. I'm genuinely speechless. And if you've come across me through Facebook or if you've come across me through just recommendations, thank you for giving me a moment. And if you've made this far in the video, I'm going to give you a little bit of an extra nugget if you ever want to reach out to me. If you ever have a question directly and you don't want to put in the comments, it's more personal, feel free to email me at Clayton'sCash, no apostrophe because that's Google, Clayton'sCash89@gmail.com. I'm not going to put in the description of this video. It's meant for anyone that watched this far, but it's Clayton'sCash89@gmail.com. If you want to shoot me an email, I'll gladly help and answer any questions I can. I can learn more about you and maybe give you more specific, but again, I'm no financial advisor. I can just give you what I would possibly do in your situation, but please do not take what I give you as fact and do your own research. I can just kind of help guide you in that way. But thank you truly for watching, and I hope everybody has a good night, and I'll be seeing you soon.